Better than expected jobless claims this morning. A lot of focus on the jobs report tomorrow morning as well. Your take at these levels?
We're very bullish, and we love new highs because an ETF, a stock, it can't double in value without hitting new highs the whole way up. So new highs should be celebrated and embraced. And to be quite candid, there's so much more fun than new lows, right?
Fair enough. Ben, I want to get your take, especially since as I look through your notes here, you say the peak growth market narrative, which we've certainly been talking about a lot here in recent weeks on CNBC, is a fallacy. Why?
Well, I mean, it's really the stock and trade of a bearish market view is this idea of peak growth. In other words, you know, the main impulse fundamentally is behind us and it's all downhill from here. That idea, I think, is flatly wrong in this environment. And you can go back in history and find plenty of examples of going from 3% growth to 2% growth. And there's a legitimate concern there that, you know, that you're approaching stall speed and the economy is going to decelerate even more. In this instance here, we're going from 12% growth to 6%, with consensus showing 5 to 6% U.S. GDP growth until the middle of next year. So we are not at stall speed. We are very far from stall speed. And the other reason is that as you look at the growth outlook and kind of the history of high growth, early cycle type of dynamics, there's a tendency to underestimate how long the recovery takes. And so this idea of pushing growth out even past the middle of next year to be substantially above trend at least needs to be acknowledged. And so if that's the fundamental underpinning for corporate earnings and equities here, then I think your default position over that period is to lean into risk. And that's how we're positioned, overweight equity.